Good community, welcome to the best community in the mortgage industry. When I interviewed Simon Sinek a little over a year ago, he said that he would have asked his loan officer, if you don't use Mortgage Coach, it'd have been a deal breaker. When I interviewed Dave Ramsey, he talked about the best way to serve a family is to ask them about their goals, their dreams, and then use a total cost analysis to show them how to hit their goals. When we interviewed the best realtor in America, he said most loan officers' marketing isn't adding value, but the total cost analysis does. So super proud to lead the Mortgage Coach community. It's amazing to have Dan Rawitch on a call. Dan and I started this annual tradition. I asked him right before the call. I can't believe it's been since 2008 that we've done this, Dan, but so grateful to have you as part of our community.
Thanks, Dave, and I'm grateful to be part of it. I really am. It's been fun.
No, it's a special community. Everyone who's on this call, everyone that's listening to the recording, not only are we endorsed and supported by the best trainers in the mortgage industry, 34% of the most successful loan officers in the industry are part of this community and use this technology. So we're here to help you understand what's happening with market trends in the market, and we're here to help you leverage mobile technology. If when you see that app on the right, you're like, what's that? Well, you're not using the best practices of Mortgage Coach. You should have installed this app. I'm going to believe that 90% of the people on this call have. I am going to do a poll at some point in the conversation. But green means rates are going down. Red means rates are going up. And one of the most beautiful parts of Mortgage Coach is that we designed it for families. We designed it for not day traders on interest rates, but so that you understand what's happening in the market, and you could just click a button. You can email it, you can text it, you can Facebook it, and you can even put it in your clipboard and add it to some other type of marketing. So our mission is to give you great content, and then to make that content super shareable, making sure that you're always aware of what's happening in the market. We believe that the best loan officers are the best teachers, and they're updated. They're getting alerts. If you're like me and you're a nerd and you have an iWatch or an Apple Watch, you're getting the alerts anywhere and everywhere. So I think we're all pretty aware of the challenges in today's market. Rates have gone up. That's a challenge. But when I talk to the best loan officers in the country, that's like not that big a deal because everybody in the industry is dealing with that. But what is a big deal is inventory. Again, depending on what market you're in, could be more difficult than others. Also, shout out to Bridge Builders, Steve Harney and Bridge Builders for providing these insights. But when you look at the far right side of these charts and you see just how little inventory we have, that is a big, big, big problem. So Dan and I are going to spend 95% of this call on a market update. But I thought I would ask one of the nation's most successful loan officers, Danny Hirani, to come in. He's got a great strategy that he's bringing to agents around how to get move-up listings for agents. And so, Danny, real quick, for those that don't know you, just let us know what you and your team did last year in production, and then walk us through the strategy that you're deploying in the market right now to address the number one challenge, low inventory.
Awesome, Dave. Thank you so much for the invite today. So yeah, last year our team had a pretty great year. We helped 874 families, and that translated to about $391 million in volume. And we're actually hoping to exceed that pretty strongly in 2017, and we're working towards that goal. And one of the things that we need to do is fully transition over to a purchase market. We were about 60% purchase in that 2016 number, and we need to transition over to somewhere between 75 to 80% purchase, which we're trending in 2017, but we're really looking to keep that up. And the main avenue to capture that business is the realtor community in our area, which is in San Diego, California. And in order to get those leads, we need to develop the relationships with the agents, provide value back to them. And their biggest pain point right now, as you just showed in those slides, is the lack of inventory. Even fantastic agents and teams are struggling to meet their goals because there's just no homes to sell. The buyers are getting frustrated, and so what we've working with you, Dave, to kind of brainstorm around this strategy, we've been opening doors with the total cost analysis by introducing to the agent that we might have a strategy that can get them some more listings. And that is, we call that the move up analysis, which is geared towards potential sellers, people that really should have sold their home based on statistics around how long they've held their home, and they should have sold. So what we do is in our realtor meetings, which we're aggressively setting and holding, we're working on introducing this concept, which is that the client can build their net worth if they sell their home and they move up into a new property and they capture today's low interest rates, even if they're in an even lower rate than what might be available to them today. And that analysis that you have on the screen there, and I think you may link it as well, strongly encourage checking that out along with the 10-minute video that really describes the strategy. The main thing that it's doing for us right now is that it's opening doors with those realtors. And even the end game here is to generate listings for the realtors, which is exactly what they need. And by relieving that pain point and us being the conduit for that relief, generate additional business from them. But even without the listings being generated, just being able to go and provide that value to them and introduce that we're thinking with them in mind by addressing a pain point they have with the tool, with the total cost analysis tool, that alone starts to provide value. And then we're seeing residual deals coming off of this even before any listings have been created.
Love it. So you're going out to agents. I would imagine it's pretty easy to get a meeting with an agent. One that you know, two that trust you, and three, you say, hey, I got a great idea to get some of your move-up buyers into a listing and into escrow into a bigger home. I mean, how many agents aren't going to like that idea? So Danny, let's not get into the details of it. Everybody on this call, homework assignment, check this out. I tried to do this video short and sweet, but in a compelling way. So it's 10 minutes and 25 seconds. Do you have that much time to listen to the, number 5 mortgage leader in the country? And then we will also, the link to this move-up buyer, it's in the description of the video. So there's a little description in the video, and 2 example TCAs are in the description. While I am on the YouTube page, I want to remind everybody that every single Tuesday, those calls are put up here. Our all-time best calls with Jocko. By the way, Danny, I don't know if you know it, but your call that I did with you guys a couple years ago called 5 Strategies to Maximize Realtor Referrals. It's, one of the all-time best calls. And I also recommend all Mortgage Coach members check that out. And then I do want to shine a light on these real-world scripts. All of these have been recorded within 2 weeks. And all of them have been me inviting someone that is extraordinarily successful. I mean, we're talking like the, not just the 1%. We're talking about the best of the best and saying, hey, what are your scripts today? You're getting rate shopped, you're getting grinded, there's no inventory. What are you doing? And I interviewed Jeremy, one of the all-time, best mortgage coach interviews. So check that out. So hey, Danny, I want to get into the meat of today's call. Any last thoughts before we bring on Dan Rawitch and rock out the update?
No, only that, these kind of creative solutions as a community, if we can just share with each other, I mean, it's a knife fight out there. So if we all stick together and introduce these things to each other, we can't help but come out on top.
Love it. Hey, Danny, really appreciate you coming in last minute. Let's take it easy and let's keep the conversation going. And as you have more results, please share them. I'd love to interview you again in a week or so.
Cheers, Dave.
All right. All right, Mortgage Coach community. So you know what we're here for. We're here to help you have a competitive advantage. Whether you're, sending a link to a family, whether you're meeting them in your office, whether you're having coffee shop meetings, whether it's with agents, we want to make sure that you are smarter than your competition. My goal is that every time a Mortgage Coach loan officer, someone that comes to these calls, someone that actually uses our mobile technology, they win. They have the obvious advantage. So Dan, I'm going to hand it off to you, my brother. I can't begin to tell you how much I appreciate the daily updates that you provide, the annual updates, and just all the value you bring to our community, my friend.
Thank you, Dave. I appreciate it. It's been fun. It is fun.
Yeah, right?
I'm not seeing the screen yet for a handoff.
Yeah, well, sometimes, it takes us old guys a couple clicks. But I finally, on my second click, I got it to you, my friend. And I see your screen.
Okay, beautiful. Let me blow this up here. All right. Good morning, everybody. Thanks for joining this call. It's an honor just to have everybody jump in and listen to me. It's also an honor to look at this picture of myself, which that guy is good looking. I don't know that guy, but Dave and I had a fun conversation. Some of you may have seen it yesterday on Rate Watch when I did the commentary on my slides and some fun comments on Facebook. But this picture is a little bit touched up. This is what Dan would look like after cosmetic surgery. This is not really what 58-year-old Dan looks like. So thanks for that picture, Dave. I appreciate it. It makes me feel young and strong.
Hey, my marketing team, they found the best picture of you, man. You can't hold a good marketing team down. They're going to make everything look great.
Well, if that's the case, I got a cool one when I was like 19. I was in jeans. I had a little six-pack with a cowboy hat on. That was cool. I'm going to send you that one.
Hey, we'll throw it in next year's update.
All right, thanks. Okay, everyone. So there's a few things I'm going to cover. One of them is I don't talk a lot about the yield curve and really what it means to the economy as a predictive tool. And since I have some time today, I want to talk about that. And I've got some good slides. And then I want to quickly review last year's predictions because those are relevant to those that are listening that might have a skeptical ear, which you all should. No matter who you're listening to, you should have that sort of skeptical sense about you. So it's helpful to really look at the model. And I do that every year. Every presentation, I start off reviewing last year's predictions. And it just gives me more faith in the model that I use. And then that's it, really. Okay, so first of all, there's 4 slides in a row, and I'm not going to read them to you, but the message is clear. Consumer optimism is really high. Now, some could say it's dangerously high because it hit these levels just before the crash in 2008, but that's not the case right now. I think there's some good reason for consumer optimism. And those of you that listened to me for a long time, and I know Dave would agree, I've been really bearish for I don't know, 8 years. I've been down about the economy. It's caused me to be very bullish on lower interest rates. Some would say I've made some rather crazy predictions about where the 10-year would hit, and most of those came true. And it's not because I'm smart. It's because I assimilate a lot of data and I use this model that works really well. So I have turned cautiously optimistic on the economy. I think that's an important note. And really, I think this year's economic forecast, my title to this is, it's a better story, unless you've been living off refinances. I'm not saying they go away, but it's a better story for the economy, and it's a better story for people in our business. It's a more sustainable story. So here's one look at consumer confidence by Bloomberg. Here's another one, another Bloomberg reporter saying that it jumped from to 98.4. Its sharpest surge since 2009. Remember, perception is reality in the economy. It is for sure. You've heard me for years talk about consumer confidence as the #1 leading indicator of what's to come. Here's another one from Steve Leisman at CNBC. He's talking about how many people are feeling good. And then lastly, another Bloomberg News talking about consumer confidence. So clearly, everyone's talking about it. I'll probably say this a few times today. I am a contrarian, and I believe to be successful, you need to be a contrarian to a certain extent. Not an obnoxious contrarian. Some people are contrarians for the sake of being contrarians. But I remember literally in Business 101, my freshman year of college, the professor got up and he said, the math is always wrong. If you follow the math, you will be average to broke your entire life. The math is always wrong. So when I start showing all of this great optimism and I say I agree, I don't feel good about it. That said, I do agree. I think the current message is accurate. So this is an interesting, when Trump came in, consumer confidence was already climbing. This is not a political slide. It's certainly not intended to be a political slide. it looks a little political in terms of consumer confidence, but you could certainly argue either way, that it went down under the Bush era, it went up during the Obama era. But clearly, since Trump has been elected, it's gone through the roof. This Trump euphoria is very real, and it's manifesting in many ways across the economy. He's got a lot of pressure to deliver. Okay, so let's start off with the yield curve and how it predicts GDP. This gets a little technical. I'm going to go a little bit slow, and I want you to please just chime in. There's a place in GoToMeeting where you can GoToWebinar where you can ask questions. Ask away. We're going to try to allow some time at the end to answer those questions. So this is a yield curve. Many of you have seen it. Some of you have not. There are 4 colors on this yield curve, and each color is a different time frame. The oldest one is the gold line. And what a yield curve simply is if you graph short-term rates all the way up to long-term rates. So this shows what a 1-month T-bill was all the way up to a 30-year long bond. Now, economists and analysts, we look at the 3 months to the 10-year. So this spread here is the spread that is the spread that I will always look at. And so I just put in this here. I filled in the slide. And so last year, during this gold line, the spread between the 3 months and the 10-year was narrow. It was 1.5% was the spread. Historic is about a 2% spread. 2% is pretty healthy. That means there's healthy optimism about the economy. Last year at this time, there was not as healthy in terms of optimism in the economy. Last month, people were feeling really good. And not so much people, but let's just say the market mentality, the overall consciousness of the market. This is a weird statement. Try to get your mind around it. So I say the mass is always wrong, but the market's always right. And that's weird because the market is the mass consciousness of everybody put together. But you almost have to think of the market as a separate brain. And the market it's all-knowing. It's always right. And you'll get broke trying to argue with it. So the last year, the expectations were not necessarily the economy was booming. My forecast showed through, and I'll show you that on the slides. Last month, they were feeling much better, and then when the Fed bumped rates, the yield curve flattened. So what that means is the Fed said, I think I'll just raise things a little bit. The Fed kind of only controls right in here. Beyond here, investors take control. So the Fed bumped up rates a little bit here, and it made the yield curve a little flatter. It made the spread 1.7. You can just see if you look at this. Let's see, which line is that? It's the pink line. It just flattened out ever so slightly from the blue line. So now, if the long end of the market said, "Oh yeah, Yellen is right. Yeah, man, the things are really taking off," then they might have raised the long end of the rates a little bit. As well, and then we would have maintained this spread, but we didn't maintain the spread. So the market is not 100% behind this increase. All right, let's look at this in deeper ways. Now, this time what you're looking at with this black line, this is the spread between the 3 months and the 10-year. That's all this line is. And what this is telling you is as of February of 2007, that spread was 1.9, which matches up to the slide I showed you a few minutes ago. This was before Yellen raised the rates. What's fascinating is these gray lines are recessions. And what this will prove to you, I don't care how skeptical you are, that this spread predicts recession and it predicts economic activity. And I can tell you with certainty going back, well, this is going back to 59, that any time that the spread reaches 0 or even near 0, what that means is if we go back for a second, let's see, why can't I go backwards? Oh, that's okay, I won't. What that means is when the yield curve gets flat, so to have a 0 spread, we actually had an inverted yield curve, meaning the short-term rates were pushed up so high and so fast, and the long-term rates kept calling BS on the Fed, and they kept going down. So short-term went up, long-term went down, yield curve inverted, recession followed. Every single time, right? You can see it. I mean, I think you'd have to be blind not to see how this happens. And I will tell you that when the spread gets even around 0.5%, we run an extreme risk of a recession. And so we had a real early warning back here in '98 before the 2000 recession. We had a very nice early morning. Let's see, here's my panel. Sorry. Back in 2006, we were listening back then. I did see this coming. I did some again, not because I'm smart, but because I watched these indicators, and the masses didn't get out until the yield curve inverted, and many people got stuck holding the ball into this recession. Okay, so hopefully that makes sense. Watching this spread is very important, and I'm going to show you kind of what's happening currently in another slide. So this is kind of the same picture in a different view. This is GDP growth year over year for the last 15 years. And it's the 10-year minus a 3-month spread. You know, I think I made that graph pretty clear for you. And what you can see again is when the 3-month spread drops significantly. This drop started in 04. GDP will follow. And what's happening now is we don't have a complete quarter here to look at, but what you can see is the spread began widening toward the end of last year. And as the spread widened, you can see that the predictive GDP growth is now going up. And this will directly overlay to the model I'm going to show you. Dave, is this making sense?
Hey, Dan. Yeah, absolutely making sense. I do want to encourage folks. I'm seeing some questions come in. So if Dan says something that's, you know, a great quote that would make a great social post, it would make, you know, a good talking point with a realtor conversation or a borrower, share that, you know, put it in questions, takeaways, quotes, and of course, if you have questions for Dan, we'll try to get to those at the end of this call. If we don't get to them, as you guys know, Dan is here to serve, and we'll get those questions answered on Facebook. We'll get them answered in his daily update, and we'll do another call if we get enough questions that are unanswered. So keep it rocking, Dan. Makes tons of sense.
Great, good. Thanks, Dave. All right, so that, I think that's just an important thing for you to know, and it is a fantastic way to look really smart with your realtors. Just grab those few slides. I assume that Dave's going to post these. If not, send me an email. I'll send them to you. Just those few slides. I'll coach you if you want to talk through them. Probably if you listen to the video and look at the slides, it'll make sense, maybe 1 or 2 more times. But you just show the realtors that, and they're like, oh, I get it. And then when you show your buyers that, they realize that you're a person that has a greater understanding of the market than the average bear. Remember, you don't have to be a genius in this stuff. You don't have to study the markets every day like I do. Just doing what you're doing makes you smarter than the average bear, and that's all you need to be to win.
Hey,
all right.
Hey, real quick, yeah, I did want to comment. I just gave this to my team. We will have these slides updated as a download in the GoToMeeting. It's called handout section, so keep an eye on that in probably about 5 or 10 minutes. And if you are listening to the recording, we will put a link to download these slides in the description in the YouTube box. So just look down, there's a description, there'll be a link to download these slides within there as a PowerPoint. And hopefully they deliver value, whether you're doing a realtor lunch and learn, however you're delivering them in the marketplace, feel free to swipe and adopt and make the most.
Great. All right. Next topic before I get into the prediction is people ask me a lot about how do these graphs get made and what does this really mean, and because we look at these charts but we really don't understand the data behind every candlestick that you're looking at, every hash on a chart, every line on a graph. There is so much psychology that goes behind this. It's actually overwhelming. And so I began thinking about this many years ago as the bandwagon, because everybody wants to jump on a bandwagon. And great traders, yeah, they will board the bandwagon, but let me show you what that looks like. So here's a happy bandwagon, right? This is going down the street, and every kid wants to jump on it. Here's an old school bandwagon. You know, this is a good bandwagon. It's weighted correctly, it's got all the instruments you need, and it keeps going down the street. But what happens in a very happy bandwagon scenario, now this is again fantasy, this isn't real life, but if you picture this happy bandwagon rolling down the street and every person walking out of their house and seeing this bandwagon, you know, oh, that's fun, I want to jump on the bandwagon, it starts looking like this, right? Thank you for jumping on the bandwagon. Please find a comfortable seat. This is not sustainable. Soon, the wheels will fall off of this truck, and people will begin to fall off this bandwagon, and they will get badly hurt. And so the third point, the third way to bring this home for you is this guy standing next to the bus sign. He's the contrarian. He is the only smart trader. He's the only guy that's going to make money, as opposed to all these guys just waiting for the bandwagon. Look at them all. Here comes the bandwagon. Now, so this guy standing by the bus stop represents, in my mind, the first very bottom of this candlestick, okay? He says, I see a bandwagon. There's not a lot of people playing on it, but that truck's got some wheels, and I think it can roll for a while. And then one of these knuckleheads turns around and sees this guy, oh my gosh, we're standing in the wrong line, and he jumps on. And the next guy jumps on, and the next guy jumps on, and the next guy jumps on. And then a few guys go, I'm a little scared, and they jump off. But still, the bandwagon is rolling, and people are still jumping on it. Yeah, people jump off, but they jump on. Now, what I ask myself every single day when I'm trading something is, when is this guy going to get off the bus? Because he's going to get off before all these knuckleheads, and all these knuckleheads are going to fall on their faces, and they're going to smell burnt rubber as the bandwagon sizzles away. And so I think that this guy probably would have jumped off, or will jump off the bandwagon right about here. He might have even jumped off. Now, granted, I did this slide yesterday, and the markets rallied considerably, but I will tell you, this guy did not count on that move because he's not no interest in being squished by everyone in the bandwagon. He's off it. And so the question is, how many more people will pile on? Because this guy doesn't get off when it's too late. He gets off a little bit early. And if we were to pull up Rate Watch today, you can see what's happened today. We had another gap up opening. It went through 102.20. Now, I don't know that it's going to have the steam can continue. And when you see this start falling, I want you to visualize people jumping off the bandwagon. How many people are jumping off? And pretty soon are they all going to fall off? And is it going to take this down? And in my personal opinion, this bandwagon is pretty tired. I wouldn't be on it right now. Now, that doesn't mean more people will jump on. It doesn't mean it can't keep riding to 102.60. But I'm just going to tell you, this guy here, he's off of it. He's gone. And he'll wait for the next time to board the next good bandwagon. Hopefully that makes sense. I want you to think about that every day. And when I'm giving you my technical analysis, remember that's what's in my head, is who's on the bandwagon, who's off. All right. Again, if you have questions, type them. Love to answer any that I can. Let's talk about last year's predictions really quickly, because it's very meaningful to see, does this model really work? And so last year, we forecasted, and this slide actually was given, this was a forecast I gave in January 2016, and so you can see what happened during the year. And we called for GDP to fall. We did the prediction back here. We called for GDP to fall down to just above 1% before it started its climb. I believe that's almost exactly what happened. We called for the 10-year bond to fall. At the time when I did this prediction, it was 2 1/8. A lot of people were saying it's over. The Fed is raising. The party's over. I said no. I believe that the 10-year will hit 1.5 one more time. The model was correct. If I showed you the math behind this model, it would give you a headache, by the way. There's so many different factors, and what you'll see is, this is another important point. All of these economic indicators, I look at the market as a human body, and every one of these indicators is an organ, and these organs all must work together. And if bonds are the heart, and stock market are the lungs, and the stock market crashes and the lungs collapse, the 10 years going to have a heart attack. It's just the way it works. So you can see 10-year predictions were pretty much right on. 30-year fixed rate mortgages were pretty much right on. Oh, and by the way, this is accident. I couldn't find the slide where this model has been dead wrong 4 years in a row. Is predicting a major crash in the Dow. Every year it has said that's going to happen, and it hasn't happened. I don't have that slide. I didn't take it out just because it was the one that made me wrong. I just couldn't find it, so I wanted to come clean and tell you. CPI. CPI inflation was darn near zero when we did the forecast, and we said that over the year it might hit as high as 2.5%, and it did. It was on the money. Fed funds, we were off a bit here. This called for 1, 2, 3, 4 rate increases, which, as you know, most analysts were predicting. This model, by the way, has nothing to do with public opinion, other economists, or anything. This is a mathematical model. So the model matched most economists economists and we've not had 4 increases. Oil. At the time that we did this, oil had fallen below 50. I think about 47. I think it did. I think it might have hit 27 or 28. But this was a forecast that some of my friends laughed at me. Said, "No way, oil goes that low." And you can see then it later forecasted it swinging back up, which it has. And then retail sales, we forecasted they would get a little bit better and they would continue to decline. They did not get that bad, by the way. Things turned around before they got much below zero, but they certainly did fall a lot. And then employment, the job creation, this one was so inaccurate. It's crazy, and it's crazy that it was this off and didn't have more effect on the other components of the model. And that's just for another day why I think that happened. All right, so hopefully that gives you some credibility, tells you the model's not perfect, but it tells you the things that we really care about. I can tell you for at least 5 years, maybe more, it's been dead on. Okay, so let's start with the Dow. Now, it's easier, rather than looking at the graphs on the left, it's easier to actually look at the hard numbers on the right, because the graph, the time frames are so wide, it's hard to understand what it's telling us. But what this tells us is the Dow does not fall this year. It is the first time the model has not called for a fall in the Dow. It makes me think the Dow is going to fall, by the way. And then there's a story there at the end about that. It does start seeing some fall off going into late 2018, 2019. We should see a correction. And we have to see a correction. I don't care how great things are. We've never had a bull run that didn't correct. So the stock market looks okay. First year I'm saying that. I'm still not in it. I still don't believe fully, but that's what the model says. CPI, I feel like this model is incredibly accurate. It says that inflation does tick up a bit, but it still stays at or below the Fed target, and then we start seeing disinflation again. I think we see disinflation for a very long time, and that's going to play out very favorably for interest rates in the years to come. And if you want to know what's the very most important thing of anything in the whole wide world that drives interest rates, it's inflation. That is the #1 driver of interest rates. And a lot of people believe that when GDP picks up, inflation follows. That's not true. There's not an absolute correlation between a growing economy and growing inflation. We can have a growth economy without inflation. In fact, we've had for several years. So I believe that inflation can stay below 2, and we can keep a GDP at or around 2.5%. Retail sales, it really came back. And you've heard me say, if you've listened to me for a long time, that consumers vote with their wallets. And the two things that I've really watched, well, there's 3 things really. If you say what are the leading indicators that lead me to give a pretty decent forecast on where I think GDP is going. 1, consumer sentiment, because that's going to drive retail sales, and then durable orders, buying washers and dryers and cars and expensive toys or expensive household goods. Those are the things that tell you the consumer is feeling good and they're going to start spending money. And you can see retail sales are really predicted to rise and stay pretty decent for the next year or 2. This is a great picture. U.S. employment growth, this year we're not predicting a fall off. It looks very strong. I worry a little bit about the quality of jobs. We're not creating many jobs above the median income. Now that's important, and every month when the jobs are released, if you dig into that data, you can see what bucket jobs are created in. I think there's 9 different buckets, and about 70% of the jobs that have been created over the last year have been in the lower buckets, food service, those kinds of areas. So it's great to have job growth, but remember this: jobs created below the median income do not propel the economy. In fact, the economy can fall if people are making below the median income because they're living hand to mouth. I've been there. I didn't help the economy when I wasn't making a lot of money. Unemployment, I think, stays pretty much the same for the next year. There's some wild forecasts that you get out into late 2019. We're not going to worry about that. As you can see, just looking at this average error, it stands to reason. The percentage of margin for error grows as time goes farther out. That's kind of a duh. It's harder to forecast farther out in the future. So I wouldn't worry too much about this. Just look at this 12 months, and I think unemployment rate looks really good. Crude oil. Crude oil has been falling a lot. I think that that's been a big driver. I said it this morning on Rate Watch. It's been a big driver in why interest rates have improved and why the Dow is falling. If you remember last year, about this time, maybe January, February, is when oil was falling, say, from 50 down into the 20s. That's when we had that humongous bond rally, and the Dow did correct quite a bit. So we're seeing a mini version of that. Oil, I think, has been falling pretty consistently for the last 8 weeks, now in around the $47, $46 level. So this is a little bit high, but we were at 49 for quite a bit of March. This does not say that oil is going to continue to fall, but it says oil continues to stay very cheap. Housing starts. I've got a lot to say about housing starts, but I'm going to start off just talking about this year, and I'm going to show you a graph later that's going to make you smile. Because this looks good, right? I mean, look at housing starts from 2011. You know, from 600. Now we're forecasting that we'll get over 1,300. This is really good news for us, and it continues to rise for the next few years. Good times ahead. Again, I don't have time to talk too much today about the housing market in general. What I will tell you is between the growth that I see coming in housing starts, between the millennials now really getting in and starting to buy homes, between the baby boomers, people my age, we're thinking smaller, not bigger now. You know, I want to go live on my boat. So you've got the baby boomers probably going smaller. You got the millennials coming into the market. And now you've got all those people that lost their homes in 2008, 2009, 2010. That was 7 years ago. They're coming back. Those are the boomerang buyers. So I have some graphs I could show you. I don't have them in this presentation today, but what they will show you is that the amount of home buyers entering the market over the next 3 years is unprecedented. Well, we saw something similar in the 70s when the baby boomers were kind of getting out of school. The first wave of the baby boomers buying homes. This is the phenomena we have coming our way. It's going to be an amazing housing market, and all these economic pictures I'm showing you match really well with this forecast in housing. Gold, I'm not going to spend a lot of time on it, but I would tell you that gold historically for me has been a leading indicator in predicting inflation, and as you can see, gold has fallen quite a bit. And I would tell you that as gold fell, so did CPI. So it did its job in terms of predicting inflation. And gold's fairly static. Maybe even right now, gold's a decent buy. I think gold could go up from 1,200-ish to 1,300-ish in the next few months. But all of this tells me I use this to confirm the CPI number. If the model was saying gold was going to go up to 1,700 this year, but I had inflation going up at 2%, I would say there's a disconnect in the model, but it's all connected well right now. Fed funds, the model is calling for just 2 increases, and I think that's going to be very, very accurate. I think we might get 1 more, and it has a lot to do with when I showed you the yield curve and that spread in those earlier slides. I think if she raises rates again, I think the 10-year is going to come down again, or stay the same, and she's going to flatten out that yield curve. And if she flattens out that yield curve, she's going to drive us to no growth and ultimately into recession. And that's exactly what happened back in 2005 when the Fed just kept raising rates. They would go up, and the 10-year would go down. They'd go up again, 10-year would go down. They'd go up again, 10-year would go down. And then the yield curve inverted, and then we had a recession. That's what she needs to be careful of, and that's why I think we'll probably only see 1 more increase this year. 10-year note, this is the one you're probably almost eager to see. What this tells you is rates are where they belong. And if you really think about what I'm saying about the economy, in the past I've always been able to make these wild predictions and say I think the 10-year is going to hit 1 or 1.25 or 1.5. Well, I had the data to support those crazy predictions. A lot of data to support it. I don't know what all these other economists were looking at when they weren't calling that, but now this data tells me that we kind of belong here at about a 2 to 2.5 10-year. The model does suggest we hit 3 at some point. I don't know that that'll happen, but I think we could take a run at it. I also think we're going to take another run at 2%. I don't think this suggests this year, but I think next year we could see a 2% 10-year. I would just be so happy to see the 10-year stay between 2 and 3% for years to come, and this whole picture I'm laying out to stay this way for years to come. It won't, but it's a good picture. That's how good I feel about it. I feel like Ozzie and Harriet in the 50s. The only thing is, I don't want a single bed, and I do want to share a bed with the lovely Miss Sophia. She's smiling. So, but that's the 50s and 60s. The economy just grew. Our parents were happy. They were raising us, driving their 55 Chevys. We had a GDP at 4 or 5%. We had inflation at 2%. We had long-term interest rates at 4%. It was a good picture. This picture looks like to me for the next couple of years. GDP right around the Fed target. It stays right around 2.5%. Above the Fed target. So why wouldn't she raise again? She might. That might be about when she raises if this model is correct. But keep in mind, as GDP was increasing during this time frame, CPI was going down. So that could be a governor to keep the Fed from raising rates. The last thing I want to talk, well, nearly the last thing is I don't talk a lot on the videos about the dollar, and I just think for your own knowledge, it's good to understand the effects of a strong dollar versus a weak dollar. And a lot of you are really smart, and you get this already. By the way, you don't have to be smart to get this. A lot of you are smart about this, I should say. I wanted to show you. So this is the slide on the left is how the euro has competed against the dollar. And I remember this is about the time that my family and I went to Europe, and God, it was expensive. I remember looking at we'll call it a $300 hotel room and saying, oh, I got to add 40% to that in dollars because it's 140 euro. So a $300 hotel room was really $420. Well, now a $300 hotel room is about $300. So the things it's a good time to be in Europe. And the model is actually forecasting a further decline in the euro against the dollar. Same is true in terms of how the peso has competed against this is an inverted look, but you can see that in 2011, for every dollar you could buy 11 pesos. Well, now it's 21. I mean, the dollar is twice as strong as it was. Going to Mexico is like shopping with monopoly money right now, and that will continue to be that way for quite some time. Now, a stronger dollar has some interesting implications. And again, I consider this a governor on GDP and a governor on inflation, because what happens is when our dollar is really strong, just think about it. If you were living in Europe in 2013. You'd come here and shop and laugh. Stuff in America is so cheap. Disneyland is so cheap, right? Because for every $1.40 they had, they could buy. For every dollar they had, they could buy 1.5 of our dollars. But now our stuff looks very expensive. It looks 40% higher than it did to Europe. Our stuff in Mexico is twice as expensive as it was before. And what happens then is GDP. The gross domestic product is comprised of many things, one of which is exports. And exports is a very big component of our economy. And so as our stuff starts looking expensive to other countries, they're not going to buy it. So that's going to slow down our GDP, right? We can't export as much stuff, so GDP slows down. Or we have to discount the price to make up for our stronger dollar, and that becomes disinflationary for the U.S., which is why I believe the model has inflation trending down in the later months of the year, and I think it's because of the strength of our dollar. China has done a lot with their currency, and I won't use the word manipulative, but they have manipulated their currency to a level that has made their stuff look even cheaper, and it kind of puts things on an unfair playing field. Hopefully that makes sense. All right, 30-year mortgage interest rates. I've got a few slides on this. One, the model says between 4.25 and at some point, maybe in the summer, we hit 4 3/4. But for the most part, you're looking at a 4.25, 4 1/8, 4.5 30-year fixed rate loan, which is phenomenal. And I'll show you how phenomenal that is right here. There's 2 points I want to make on this slide. 2 very important points. Point number 1. This period that I lined out here, it was what I call the golden days when a lot of you were driving Ferraris, I was flying fancy airplanes. These were the fun times, right? Now, and this is what housing starts were doing. Housing starts were going crazy. But look at where interest rates were. I mean, housing starts are going through the roof. We were all making money hand over fist, and interest rates were in the mid-5s and 6% range. My point being, these rates in the 4.5% range are fantastic, and don't ever believe anything different. The worst thing I see loan officers do is focus on, well, I don't have 3 3/4 anymore, and they think the consumer cares about yesterday. The consumer does care about yesterday if you tell them about yesterday. But if you tell them about how great this is, because look where we were back during some of the best real estate years in history, we were 2% higher. The second point I want to make about this slide is we think housing starts are good right now, right? They look good because that last slide I showed you was from here to here. Well, that ain't squat, because this is where they were. This is where they will be. This is where they should be. And you can see there's many wild times. I talked about the roaring 70s. I remember my dad made a fortune in real estate. This is where they were in the 70s, in the 80s, in the 2000s. We got a long way to go before I would say this is a completely recovered market. Don't forget that, and use it to remind yourself that we have some good times ahead, and use it to remind your borrowers that these are really good times. So those are my predictions. You can see on the 30-year fixed rate loan, as we said, just to recap, 4 1/8 to kind of 4.6, 4.7. And let's look at Fannie Mae, Freddie Mac, MBA, and NAR. The average of all 4 quarters, or all 4, sorry, range from 4.25 to 4.5. So the model lines up very well with the agencies. That does make me a little nervous because I'm a contrarian, but I think it's right. I really do. And then I won't read these to you, but you can see HSH, Zillow's chief economist, First American Title's economists, Realtor.com's economists, and NAR's economists are all calling for around a 4.5. I guess Fleming at First American is saying something closer to 5%. And I guess our model got there, maybe 4.7. I think he's aggressive. But most of these are kind of right on top of the MBA predictions. All right, so in summary, before I answer some questions, consumer perception is a huge driver. Continue to watch that. And when I talk about consumer perception, there are a couple of different measures. There's 3. One is, how am I feeling right now? And how am I feeling about the future? And how am I feeling kind of overall? And I always look at the future number. And the future number, for the first time in a long time, is better than the present number. Home sales have leveled and will grow. Prices, I mean. We did get the FHFA numbers this morning. It was flat. I just think slow, 2%, 3% appreciation. We really want that. We don't want double digit. The double digit numbers were not sustainable. If you go back to the 20s, there's a 1-to-1 correlation between income growth and housing appreciation. 1-to-1 growth. And so over the last few years, we've had 20, 30% appreciation in some markets where income grew 5%. So I like seeing these home prices. You know, you can kind of guess where they are. Fed target yield curve that I showed you. I think the Fed target of keeping inflation at 2.5 and GDP at 2.5, very achievable. Job growth is challenging. I don't mean so much in the number of jobs, but I mean in the quality of those jobs. I worry a bit about manufacturing and business investments. Those investments have kind of tapered off. But I think that the Trump euphoria might trigger some more of that. And then probably the biggest concern that I have, and this concern could manifest well for you that like to do refinances, we all do. Greece, Germany, Italy, and Spain all concern me. I think Greece is about to default yet again on their bonds. Germany has such a huge problem that has to do with immigration, open borders. They have a big problem coming. Plus they have aging population. They're going into the same cycle that Japan has been in for the last 10 years, where their people just got old. And once we hit 47 years of age, our peak spending years behind us. We start spending less. That's happened in the U.S. Guess what? Guess when we hit 47 years old? We hit 47 years age on average in 2008, exactly when the recession started. So there's no magic here. The macro demographics work. Japan's 47-year age hit about 15 years ago when their downturn started. Germany just hit it pile that onto Germany's immigration problems. They're letting anybody and everybody come into their country, and they're basically taking from the system. They're not contributing. They're not paying taxes. And Germany it's a concern. Any one of these countries could create liquidity issues or default issues, and that's kind of in the back of my mind when I say the Dow could have a huge correction this year. It could start as simple as something happened with one of these other countries, and when that happens, and we get a 5, 6, 7, 800 point, maybe even a couple thousand point correction in the Dow, you're going to see bonds plummet again, and you could see a 10-year back below 2%. It's very possible. So I think overall rates 50 basis points above last year on average look justified unless what I just talked about manifests itself. Those are my slides, Dave.
Boom. So great update. Super appreciate how you bring this to the market every single year. I mean, we are flooded with questions. We're not going to be able to get to all of them. First, I want to make sure everybody has what you need to take action on this throughout the year. So just a reminder, this is recorded. It will be in our YouTube channel. A link to the recording will be available. So within that description, just download the link. But most importantly, you guys all have the Mortgage Coach app. So you can see what's happening on a daily basis. You get alerts on what's happening, not to mention the fact you get alerts when someone views your total cost analysis. But just this reminder that get used to pulling your mobile phone out of your pocket or out of your purse and using it as an educational tool. Get used to sharing it. So I think that the most important thing I hope folks get away from or take away from this call is that you have this app. And remember, every morning Dan is providing us with an update. So that quick update can be shared. There's other solutions out there where they don't want you to share it. Our whole goal at Mortgage Coach is to change how people get into debt. We want when someone gets into mortgage debt, they're well informed. They make the right decision based off of their personal goals. They understand the options. They're dealing with a loan officer that's well educated around the marketplace. So we want to just make it easy for you to share. We don't care if head of production takes this link and shares it with their team. Facebook, email, text it, however you want to do it. You can share all the screenshots, and you can share Dan's morning update. So even in the commentary where we've got Neil, we have other users, we have Bill Hart in here all the time, we have Todd Duncan, we're out there aggregating the best content from the best leaders and just making it easy for you to share. Also, if you haven't done it, it's really easy, just do it. But you can go to our website, you can download our Getting Started guide, whether you have an Android or an Apple. We show you how to share that Mortgage Coach report. So just some more action that I want to drive for everyone is, we want to take you from delivering rates and fees with emails, with worksheets, and we want you to make it a great experience. Whether that family is coming into your office, we want to make sure you're using a mobile device. We want to make sure that the family walks out with your mobile devices. That includes Mortgage Coach and any other apps that your company supports. At the end of the day, you want to make it easy for families to do business with you, and you want to make it mobile, which means you need to be mobile. You need to be able to pull your app out, whether that's showing a move-up analysis, whether that's showing someone their purchase options, whether that's showing them what's happening with interest rates, whether it's good or bad. We need to help you do that. So here's something I want you guys to wrap your mind around. And whether you're a branch manager or you're a loan officer, I think most of the mortgage companies out there that I know of, they already have technology that surpasses their utilization by the humans, the loan officers. You guys are not using your mobile apps as much as you could and as much as you should. You're not using the tech that your company provides you as much as you can. Or, hey, you're an individual loan officer and you bought this stuff and you're just not using it. Like, you're behind. And here's the other belief that I have, is that it's moving really fast. 6 months from now, technology is moving quickly. Everybody's chasing the rocket. Everybody's upgrading their mobile platforms. And so you just need to learn faster. So my hope is, it's not about going wide, it's about going deep. I hope you go deep in the Mortgage Coach community. I know we are dedicated to preparing loan officers to crush it in the new world, and that means mobile. making sure that you know how to pull out your mobile device, use it when it's appropriate, leverage the other mobile, again, there's other mobile apps that are important for you to be successful. Leverage those mobile apps, leverage your CRM, leverage your technology in a way that crushes it. So as a reminder, every single day of the week, we do training, at Wednesday at 11 o'clock, literally immediately following this call, every Wednesday, we do a mobile workshop where we teach you how to use our mobile apps in all the various ways. So, I'm not going to ask everybody to extend their educational in the middle of the day to 11, but sign up for next week, and you could do that on our website. And I want to remind you to subscribe to our YouTube page. Make sure you subscribe to it. Make sure that you share this with your team. But most importantly, just make sure you take action. So I want to push a quick poll question. First of all, how often do you use the Mortgage Coach app right now? Are you using it daily? Are you using it weekly? Have you not downloaded it yet? I mean, now is the time to be candid. Dan and I want to know, because we are looking at other educational things that we could do with you guys to help you, and it would just be good to know where you're at. And by the way, only 34% of you have voted. Anybody who comes to my educational events knows that we need to get that to 70%. So for all you guys that are just kind of like don't want to vote, just come on, vote. Let us know where you're at. Again, right now we've got about 50% of you have voted. Oh, boom, we just got it pushed. So Dan, there's the results. I just shared them with everybody. 28% haven't downloaded. Let's hope that changes after today's call. 41% of you use it every day, so great job. Most of you, it looks like you're using it either daily or weekly. So, kudos to you on that. Right now on my screen, you are looking at the app live, so like, I click, I go to Day Watch. This is what's happening in the market right now. This is where rates are at for the day. Hey, Dan, I know you're a big fan of the Mortgage Coach Rate Watch app. What are a couple of your favorite features on this app?
I personally love the alerts because, I get busy during the day. I'm running around and getting that little pop-up alert. And like you, Dave, I have the Apple Watch, and especially when I see that on my wrist, it's really good for me in my job because I can go in and then look at our locks in my region, and then I can encourage people, hey, this is happening, time to take some action. So I love that. And what you have up right now, the Day Watch, is a very powerful graphic. A lot of really smart loan officers will use this to create borrower urgency. And whether it's Day Watch, if you want to show a short-term picture, but when that number's falling off a cliff, and you look at that picture right there, Dave. If you were talking to somebody that morning, and suddenly it started falling off, and you call a borrower and say, I want to show you this. It might be a good time to lock. That is so graphic and so real, and people really pay attention to that. So it's priceless.
Yeah, and what I was also showing is you could go back to a previous date. So, sometimes you're using it, what I call offensively, to say, hey, look, I've got my pulse on the market. I know what rates are doing. We're the only, solution that actually has the optimal blue midday rate change. So we actually not only know what's happening with MBS forward thinking, we know what actually happened in real time as midday rate changes are happening. So we can see that, 38% of lenders have changed rates for the better. So, whether it's offensive and you want to be able to really visually make the case that what's happening, or sometimes you're playing defense, and it's like you talked to that borrower 4 days ago, or you talked to them on the 14th, and you could say, look what happened on the 14th, and it's not just me. See, it's offense and defense. So I just can't urge you enough to make sure you download that, make sure you take action on it. I do want to push one more survey question because Dan and I, we're just all about delivering value. So do let us know, did we surpass your expectations at today's call? Did you get a lot of takeaways of value? If you are a guest, you're not part of the Mortgage Coach community yet, you're not a member and you'd like to get a demo, click that last option. I'd like to learn more. get a demo of Mortgage Coach, let us know. So Dan, it looks like we crushed it, my friend. Everybody is voting, and looks by far surpass expectations is where we're at. So last thought as we wrap it up, we will post a recording to this on our YouTube, or not, it will be on YouTube. It will also be on Facebook. I'll probably share it personally because that's what I do. If you do have questions, submit them in the comments on our Facebook page or submit them in the comments of YouTube, and myself and Dan will try to get answers. I did see a lot of questions where my answer would be, go and listen to other calls that I've done with Dan. We've done a lot of education together. So, if you just want to learn like MBS basics or what's the relationship between mortgage-backed securities and interest rates, because some of you folks asked that, we've answered that 10 ways to Sundays and other calls. Today's call was really, Dan's market update, providing, it wasn't about MBS, it was about what's going to happen in the marketplace and what are the indicators that drive MBS and interest rates. Dan, any last words of wisdom as we wrap up today's call?
No, it does surprise me that so many people have not downloaded the app, and even in my own company, I get a little frustrated, and probably I'm preaching to the choir here. But for instance, I'll get some of our branches saying, "Hey, how come you don't send your daily video anymore for RateWatch?" And I say, "Well, because it's on RateWatch app downloaded, and you'll get a notification the second that I release it." It's just it takes 2 seconds to download it, and the value that it'll give you every day, it's a no-brainer. And it's part of Mortgage Coach. It's not like you're having to pay for this, unless you're not a member of Mortgage Coach. In that case, that's another discussion we should have. But I just think you should do it.
All right. Well, hey, everybody, have a fantastic day, fantastic week, and it's an honor to serve you, and we'll see you on the next Mortgage Coach experience. Bye now.
Thanks, everybody. Thanks, Dave.